Some years ago, I had more than 20 funds in my portfolio. I was trying to understand mutual funds, so I experimented a lot. Over time, without me realizing it, I end up with more than 20 schemes. Now, during all this time, I would check my portfolio regularly. While I had schemes that were doing well, some even delivering 18 to 20% returns, my portfolio returns were not even in double digits. So I decided to dig in, and after some analysis, I realized I had made one of the classic mistakes in portfolio building and management. The mistake was having too many funds. With this understanding, I went about clearing my portfolio, and while it took some time and effort, I did it. And I'm glad I did it. This one change helped me improve my returns. Also, tracking my funds is very easy now. Hello and welcome to the ET Money channel. Today, we will talk about how you can reduce the number of funds in your portfolio and optimize it for your returns. We will discuss a number of strategies that can help you do so. Broadly, this video has 3 sections. We will first talk about why too many funds negatively impact your returns. Then we will look at what is the correct number of funds in the portfolio. And finally, we will discuss approaches you can take to bring down the number of funds in your portfolio. So let's start. Let's first discuss why we end up with too many funds. Of course, each person has a different story about this, but there are some common threads. We always chase performance, so we invest in funds that are doing well at the moment. But when the fund stops performing, we simply stop our SIPs and start investing some other fund that has topped the charts recently. Another reason is plain simple excitement. As I confessed at the start of the video, I also had too many funds. I had them because I wanted to explore them all. Fortunately, I saw sense and eventually stopped. Now, some investors are also missold funds by agents and distributors, or if you have relatives selling funds, you find it difficult to say no. Some funds like tax saving funds have a lock-in period, so you can only exit old funds once you complete the lock-in period. This can also result in more funds in your portfolio than needed. These are some of the main reasons. As I said, everyone's story is different, but if you have plenty of funds in your portfolio, that's probably not good. Let's see why in the next section. There are 3 reasons why you shouldn't have too many funds. They are challenging to manage, they can pull down your returns, and your portfolio becomes over-diversified, almost index-like. Let's talk about each of them. The first point is pretty self-explanatory. Who would deny that if you have 20-30 funds in your portfolio, you will never know what's actually going on? There'll be funds doing well and there'll be ones doing poorly. There'll be duplicates, there will be funds that have little money, and so on and so forth. And if you want to invest fresh money, you won't instantly know which one to invest in. A good investment portfolio is like a garden. To make it flourish, you need to take care of it. If you let weeds grow unchecked, your garden won't look good. Too many funds can also pull down your returns as the deserving ones don't get a sizable allocation. Let me explain it with a simple example. Let's say there are 2 portfolios of 10 lakh each. The first portfolio has 5 funds and the second has 20. For the sake of simplicity, let's also assume that you invested an equal amount in each fund. After 10 years, all funds gave 12% returns. But one fund in each portfolio outperformed and gave 22%. But what do you think would the portfolio returns be? Surprisingly, in the portfolio with 20 funds, you will accumulate around 33 lakhs. But in the portfolio with 5 funds, you will end up with over 39 lakhs. The returns of a portfolio dropped suddenly only because there were too many funds in it. Now, this is just an hypothetical example. The reality is harsher. In a large portfolio that is left unattended, the underperforming schemes can seriously bring down aggregate returns. So a simple thing to boost your portfolio returns is to limit the number of funds so deserving funds can showcase their magic. The third point that I mentioned earlier was related to over-diversification. Say you have 20 equity funds. Now those 20 funds will each have say 50-70 stocks. Of course there will be duplicates as well, but still you can expect your combined portfolio to have around 500 unique stocks. Your portfolio in sum is index-like. Let me give you a simple example of this. Suppose you invested in the biggest actively managed funds from the large, mid and small cap categories. So we'll have 3 ones: ICICI Blue Chip Fund, HDFC Mid Cap Opportunities Fund and the Nippon India Small Cap Fund. In just 3 funds, you would have more than 275 unique stocks. If you wanted to invest in an index, you could have opted for an index fund and saved yourself tons of efforts, right? You would have also paid a lot less as well. You probably invested in active funds to get better returns in the index. But when you invest in too many funds, that purpose is defeated. Let's now move to the second part of this video. How many funds should you ideally have? There is one straightforward rule. You must have as few funds as possible in your portfolio. Let me explain. When you invest in a mutual fund, you get a diversified portfolio. That's one of the many advantages you get while investing in mutual funds. Even if you invest just a couple of thousand, that money gets spread over the entire portfolio. The portfolio of an equity fund can have anywhere between 30 to 80 stocks. So your investment is getting distributed across all of these. So even one fund is enough if you have a small corpus. You may need diversification as your corpus grows. But each fund must have a specific purpose. For example, a debt fund and a gold fund can give stability to your portfolio when markets correct. A mid-cap fund can help improve returns. Still, your portfolio doesn't need more than 6-7 funds. You can achieve maximum diversification with just 7 funds. Large, mid and small cap funds can give you diversification across market segments. So that's 3 funds. Debt and gold schemes can help diversify across asset classes, and an international fund can give you geographic diversification. That's a total of 6 funds. And as we discussed earlier, fewer funds also mean better performance. Now, if you have more than this number, the strategies discussed in the next part of the video will help you bring it down. So here we are at the core of this video. Here we will discuss a range of strategies that you can apply to reduce the number of funds in your portfolio. Of course, not all will apply to every case. So feel free to use the ones that make sense to you. Let's start with the first strategy. Understand the allocation of each fund. First, you must check how much money you have allocated to each fund. Let me give an example to explain this better. Let's say your total portfolio has 10 funds and its current value is 10 lakhs. 3 funds have 2 lakh each. It means each has a 20% weight in your portfolio. Their total weight is 60%. Similarly, some of the remaining 6 funds might have 10% weight, some 5% and so on. So the first step is to list the weight of each fund. And now if you have some funds comprising less than 5% of your portfolio and you have stopped investing in them long ago, exit them. Such an investment won't add any value to your portfolio. Their performance or underperformance is of little importance. So it's better to get rid of them. After this, look for underperformers. It's easy to say you must exit underperformers. The question arises here is, when would you call a fund a chronic underperformer? If a fund has been underperforming its peers for 2 or more years, it can be termed as an underperformer and we could consider exiting it. Another option to identify is to look at their fund report card on the ET Money app. You will see the fund's ranking on 2 key parameters. The first is the fund's ability to deliver returns consistently. So the funds that have done well over time get a better ranking than the flash in the pan performers. The second is how consistently the fund has protected the returns from volatility. So the funds which have displayed an ongoing ability to keep ups and downs low get a better rating. Now these ratings are calculated based on an intelligent mix of long-term and short-term performance, and this makes them even smarter. Now one concern investors have while exiting funds is that they will have to pay tax on the gains. However, it is better to pay the tax and invest your money in a more deserving fund than stay invested in a poor performer. For example, let's say you have invested 1 lakh rupee in an equity fund 3 years ago for a target time horizon of 10 years. In the last 3 years, the fund has given an annualized return of just 8%, and it's likely to deliver a similar returns in the future. Now you have 2 options. You can stay invested in the same scheme and keep earning 8% returns. After 10 years, when you finally redeem the funds, your corpus will be as shown in the table on your screen. The second option is to redeem your money from the scheme, pay the applicable capital gains tax and invest in a better performing scheme. Let's say the better performing fund gives an annualized return of 12%. At the end of 10 years after buying the first fund, when you finally redeem the second one, the returns you will receive are shown in the table. So in our example, you stand to earn more in a better performing fund despite paying the tax on the redemption of the poor performing fund. So it might be a good idea to switch to a better performing fund. Though you may have to pay tax on exiting a a better performing fund can more than compensate for it. Alright, let's move to the next strategy, exiting redundant funds. This is very similar to exiting underperforming funds. You have to make tough choices and stick with them. So when you have too many funds, it's natural that several of them would be of the same type. You may have 2-3 tax savings and 2-3 small cap and flexi cap funds. To reduce the number of funds, you can compare the performance of funds in the same category. Consider exceeding the funds with relatively worse performance. Now, if you cannot make up your mind, look at the parameters beyond returns. For example, you can compare the volatility, how long the funds have existed, and so on. These additional factors can help you take a call on the fund you want to retain and the fund you want to exit. Okay, now let's talk about the next strategy. Let's understand why you should not have multiple schemes from the same fund house. Portfolio overlap is a hidden risk in your portfolio. But first, why is that? Now, 2 or more funds are said to have portfolio overlap when a significant percentage of their holdings are the same. So if your portfolio has funds with portfolio overlap, you may have more than one fund, but that is not getting you the benefits of diversification. Now let's understand why portfolio overlap happens. There are 2 reasons for this. First is the fund's investment universe. Now each scheme has a strictly defined universe of stocks where it can invest. For example, large cap funds have to invest primarily in the top 100 stocks. These restrictions can result in common stock holding across funds. For example, we looked at the top 10 stocks of the 3 largest actively managed large cap funds. Now, as you can see on your screen, these funds have significant overlaps in the top holdings. So there is no point in investing in the same stocks using different mutual funds. Now, let's talk about the second reason. AMCs often have investment philosophy that manifests in their funds. So you may find the same stocks across its funds from different categories. For example, we looked at the same stocks in the different schemes of Axis Mutual Fund. As you can see, some schemes have significant overlap. But it's not only Axis Mutual Fund's equity schemes that exhibit such an overlap. We have found such overlaps in the schemes of other AMCs as well. This happens because AMC's investment team and analysts follow the same investment philosophy. They want to invest your money in the stocks that they feel are the best. Unfortunately, we cannot entirely remove this problem of overlap, but we can reduce it by diversifying across fund houses. When the AMC changes, the investment philosophy also changes. So the change of portfolio overlap goes down. Now, if you have multiple funds from the same fund house, here is how to shortlist which one to keep and which one to exit. First, you can check the top holdings. If they are similar, you can consider exiting them. The second is checking the benchmark. If 2 schemes have similar benchmarks, you must consider exiting one. Now let's talk about the next strategy. You must exit sector and thematic funds. As their name suggests, sectoral and thematic funds invest in specific sectors and themes. For instance, consider an IT fund. It's a sectoral fund and it will primarily invest in companies related to the IT sector. On the other hand, a consumption fund is a thematic fund. It bets on companies that will profit from rising consumption levels. This theme may in turn cover sectors like FMCG, consumer discretionary, auto, banking, etc. So a thematic fund often has a broader mandate than a sectoral fund. As an investor, you should avoid investing in both sectoral and thematic funds. As discussed, sectoral funds have a narrower focus, and if the sector fails to perform, your returns could suffer. And no sector remains at top forever, and with changes in economic cycles where sectors do well and poorly. Take a look at the table on your screen. It shows the performance of some sectors vis-a-vis the Nifty 500. The green blocks show outperformance over Nifty 500 and the red blocks show underperformance. The same argument goes for thematic funds as well. While they can be more diversified than sectoral funds, they still focus on themes, and if this theme fails to perform, your returns will suffer. From time to time, different themes emerge as the market's favorite. Till the time a theme remains so, the funds based on it will do well. We have seen in the past how themes like housing, infra and ESG have gained prominence only to lose their significance soon. See the chart on your screen. It shows the annual returns of some thematic categories. So different sector themes have outperformed the Nifty 500 during different periods. The outperformers keep changing. For an average investor, it would not be possible to predict which sector or theme would work in the future. Moreover, you need not bother yourself with that as a mutual fund investor. Your fund manager has to deploy the money in the appropriate sector or theme. So you can consider exiting sectoral and thematic funds in your portfolio and focused only on the diversified ones. We have a detailed video on this topic and the link is included in the description below. The link is also available on the top right hand side of the screen. This takes us to the next point, assessing the need for debt funds in your portfolio. Debt funds are needed for short-term goals or as debt component in your portfolio. They provide the ease of rebalancing. However, often investors end up with more debt funds than are required. For instance, one can have overnight funds, liquid funds, short duration fund, corporate bond funds, and so on. A combination of short and liquid duration funds is good enough for most purposes. Liquid funds are alternatives to your money you keep in your savings bank account, and short-term debt funds on the other hand are alternative to fixed deposits. Debt funds high on credit risk or duration risk can be avoided altogether. Such funds tend to be far more volatile. So you can conveniently ignore categories like credit risk funds, medium duration funds, long duration funds, and so on. It's worth remembering that debt is for return of principal and not return on principal. So don't chase returns in debt funds and don't go for too many debt funds in your portfolio. Now let's talk about the next strategy, preparing your model portfolio. Like it or not, the unfortunate fact is that many of us start investing without a financial plan in place. So as we get some surplus, we invest it in a fund. Then we find another interesting fund, we invest in that too. Over time, we end up with many funds in our portfolio. The solution is to go back to the drawing board. So if you were to start investing now, how would you do so? Which fund would you have as per your requirement? Maybe you will need to think hard and give it some of your precious time. But it's worthwhile as you will get to understand your requirements better. Now here are some basics you can use for the model portfolio. First, decide on your equity, debt and gold allocation. You can have one debt and one gold fund. Within equity, decide how much would you like to have in large, mid and small caps. Based on this, you can pick funds from different categories. Now, this is a basic structure and the final allocation should be based on how much risk you are willing to take. Now, if you want to identify the red flags in your portfolio, you can use the ET Money Portfolio Health Check. It's free and it can be a good starting point for this cleanup exercise for you. You can get your portfolio on the app in just one tap and run the portfolio health check to see performance on some key parameters. Alright, let me summarize what we have discussed in this video. Investing is essential for fulfilling your goals, but it is equally important to track and manage your portfolio. A lean portfolio can not only simplify the managing work, but it also tends to be more rewarding. To clean your portfolio, you can do a number of things we discussed in this video and which are summarized in the table on your screen. I hope you would have found the suggestions useful and you will apply these strategies to your portfolio. Alright, with this we have come to the end of the video. If you liked the video, do give it a thumbs up and share it with your friends and family. We'll be back with an insightful video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.